Let me be brutally honest with you. Leverage doesn't make you smarter, it just makes your mistakes bigger. But when things are going well, leverage feels like intelligence. You borrow money, your positions grow larger, your profits grow faster, and suddenly people start calling you brilliant. That's exactly what happened to me. For a while, I believed my success came from superior thinking. But the truth was much simpler. I wasn't smarter than the market, I was just louder because leverage amplified everything I did. And when the market turned, that amplification worked against me. If you're watching this in your 40s, 50s, or even 60s, chances are you've already seen people chase fast money. Margin trading, borrowed capital, loans for investments. It always begins with a simple thought: if I'm right, I'll make more. That logic sounds perfectly reasonable. But what most people forget is this: leverage doesn't care whether you're right or wrong, it only magnifies outcomes. And when outcomes turn negative, leverage doesn't give you time to recover, it demands payment immediately. I learned that lesson in the most painful way possible. Today, I want to explain the exact psychological trap that leverage creates. Because leverage doesn't just change your portfolio, it changes how you think. It makes you faster, more confident, more aggressive. But the market rewards patience, not speed. By the end of this video, you'll understand three critical lessons: why leverage tricks your brain into feeling smarter than you are, why time not capital is the real weapon of wealthy investors, and how to protect yourself from turning a temporary win into a permanent disaster. Here's the first trap: leverage makes luck look like intelligence. Let's say you invest normally and make 10%. That's good. But if you invest with borrowed money, that same move might produce 30%, 40%, sometimes even more. Suddenly, people admire your strategy. They ask how you did it. But what they're really admiring is amplification, not wisdom. I experienced this firsthand. My trades looked brilliant because the numbers were big. But big numbers don't always mean smart decisions. Takeaway for you: if leverage is responsible for most of your returns, your intelligence hasn't improved. Your risk has. The real power in investing is patience. Time is the most powerful ally an investor can have. Without leverage, if a market drops, you can wait. You can reassess. You can stay calm. But with leverage, patience disappears because borrowed money comes with deadlines, interest, margin calls, pressure. Suddenly, the market controls your time. And when the market controls your time, it controls you. Takeaway for you: never structure your finances in a way that removes your ability to wait. Time protects investors, debt removes that protection. When you're using leverage, everything becomes urgent. You check prices more often, you react faster, you feel pressure to move constantly. Instead of thinking long term, you begin thinking about survival. But investing isn't supposed to feel like a race, it's supposed to feel boring. Calm investors survive. Panicked investors make expensive decisions, and leverage manufactures panic. Takeaway for you: if your investment strategy increases stress instead of reducing it, something is wrong. Wealth should slow your life down, not speed it up. Here's the most dangerous side effect: leverage doesn't just amplify returns, it amplifies ego. When your profits grow quickly, your confidence grows even faster. You start believing you've discovered something special. You think you've mastered the market, but what you've actually mastered is risk, and risk always collects its debt eventually. The market has a way of humbling people who think they figured it out. I was one of them. Takeaway for you: if success makes you feel invincible, you're standing on very thin ice. Here's the deeper lesson I eventually understood: Leverage creates fragile systems. They look powerful when conditions are good, but the moment volatility appears, fragility is exposed. Strong investors build systems that can survive bad years. Fragile investors build systems that only work in perfect conditions. And markets rarely stay perfect. Takeaway for you: the goal isn't maximizing gains, the goal is surviving uncertainty. Let me clear up a few myths about leverage. Myth 1: smart investors use leverage. Some do, but the smartest investors know when not to. Avoiding leverage often requires more discipline than using it. Myth 2: debt accelerates wealth. Sometimes, but it also accelerates collapse. Speed works both directions. Myth 3: if you are confident, leverage is manageable. Confidence doesn't control markets, markets control outcomes. And confidence disappears very quickly when debt is involved. If you want to protect yourself from the leverage trap, remember this simple framework: CALM. C, control risk first. Always ask, what happens if I'm wrong? A, avoid borrowing for speculation. Debt should build assets, not amplify bets. L, lengthen your time horizon. Time is the most powerful force in investing. M, maintain humility. Markets punish arrogance faster than ignorance. I confused leverage with intelligence. For a while, it made me look brilliant, but eventually I learned something. The market teaches everyone. Borrowed money doesn't make you smarter, it just makes your mistakes louder. Real wealth isn't built through speed, it's built through patience, discipline, and systems that survive mistakes. If you want more honest lessons about money, markets, and the mistakes most investors never talk about, subscribe and don't miss the next video. Because in finance, the difference between success and collapse is often just one bad decision amplified by leverage.